Welcome back to The Explainer. So if you're watching the daily charts right now, you're probably feeling that exact same exhaustion as everyone else in the market. I mean, retail traders are just incredibly stressed out by this relentless, range-bound volatility we're sitting in today on May 11th, 2026. But, if you look past that daily turbulence, a completely different story is unfolding. While retail is kind of panicking over these minor dips, the smart money is quietly, methodically building a massive institutional foundation. So today we're going to cut through all that daily panic and look at the actual math, the infrastructure deals, and the structural shifts that are literally reshaping this market from the ground up.
Okay, so here's our roadmap for today. We are covering 1. The Great Macro Disconnect. 2. Quality over quantity. 3. Miners pivot to AI. 4. Holding duration is king. And finally, number 5, establishing the true market mean. Let's dive right in.
Starting off with Section 1, the Great Macro Disconnect.
To really understand why the crypto market feels like a massive psychological stress test right now, we have to zoom out. We need to look at this incredible decoupling happening before our eyes. We are literally witnessing the longest, most pronounced decoupling between traditional equities and the crypto market that we've seen in years. On one side, you've got the S&P 500 right in the middle of a $6 trillion melt-up driven almost entirely by AI greed. But on the other side, Bitcoin's recovery has slammed into a strict Fed ceiling. Without the return of that traditional cheap money liquidity, Bitcoin is just trapped in a range-bound struggle while stocks completely race ahead.
That brings us to Section 2, quality over quantity.
Now, just because the price is range-bound absolutely does not mean the industry is standing still. Actually, we're entering this ruthless quality over quality phase. The market is actively filtering out the weak players and concentrating capital in the high-utility, institutional-grade block space. Just think about this $3 billion figure. This is not speculative trading volume, guys. This is one of the largest infrastructure agreements of the entire year. ETHGas and ether.fi have struck a massive deal, specifically designed to advance institutional block space markets. So what does this actually mean? It means major financial firms are paying a massive premium to guarantee high-speed, reliable access to Ethereum's settlement layer as asset tokenization scales up. They aren't waiting around for a bull market to build, they are locking down the pipes right now.
And we're seeing this exact same trend over in Europe, which is brilliantly illustrated by a new legal bison analysis on the upcoming MiCA regulations. Out of 174 registered crypto asset service providers, or CASPs, do you want to guess how many actually possess the regulatory standing and technical infrastructure to legally operate a centralized exchange in the EU? Just 14. Wow. We are staring down the barrel of a massive SEC squeeze. Capital really has no choice here but to concentrate into these 14 highly regulated brokerage-grade platforms, which is effectively forcing liquidity to mature.
We're even seeing this consolidation happen at the ecosystem level. Ripple just announced they're merging their major Swell and Apex events into a single, unified summit. It's a very strategic move to get developers and major finance leaders under one roof. Why? Because their focus has completely shifted toward institutional integration, specifically getting the XRP ledger integrated into sovereign debt settlement and expanding global domestic payment infrastructure. Again, it's all about this high-level structural maturation.
Moving on to Section 3, miners pivot to AI.
So while exchanges and protocols are consolidating, the Bitcoin mining sector is going through a radical rotation of its own, and frankly, it's causing some immediate sell pressure. The major mining firm Cango is the perfect case study here. They just officially completed a massive liquidation, offloading $442 million worth of their Bitcoin holdings. And why? To secure $75 million in fresh capital to fund their new EcoHash AI platform. It's wild, but miners are basically deciding that crunching data for AI is currently more lucrative than hashing blocks for crypto. That $442 million is a ton of new supply hitting the market, which, perfectly explains that heavy price suppression we've all been feeling.
Which leads us to Section 4. Holding duration is king.
Okay, so with these macro headwinds and miners dumping, what is the everyday investor actually supposed to do? Well, you have to look at the undeniable math. Brand new research from Bitwise just shed light on what they call the holding premium, and the data shows a really stark divide. Short-term traders are getting absolutely bruised right now by this range-bound volatility, right? They're desperately seeking immediate breakouts that just aren't materializing. But for long-term investors, the math shows the stress cycle is effectively ending. As Bitcoin matures, holding duration has literally become the single greatest predictor of your ROI. The math heavily favors patience, while the market shakes out the impatient hands.
And this lines up perfectly with current expert sentiment. John Haar, the managing director at Swan Bitcoin, just released a major report pushing back really hard against the recent panic. He flat out states the Bitcoin bottom is already in. A lot of folks have been looking at old models, like the CVDD bottom signals, and fearing a drop below 50,000. But Har outlines 9 specific reasons why comparing this current market to past cycles is just fundamentally flawed. The institutional support structure we have today, the ETFs, those $3 billion blockspace deals, the regulatory clarity, it all makes the current floor vastly more durable than most retail traders realize.
Finally, Section 5, the true market mean. Let's bring all these data points together. We've got macro headwinds and selling miners, sure, but we also have massive institutional infrastructure and incredibly durable bottom signals. So what does this mean for the immediate future? Well, the crucial dynamic is this number, 270,000 Bitcoin. While Cango and other miners were busy dumping hundreds of millions of dollars of Bitcoin onto the market, on-chain data reveals that whales were quietly accumulating 270,000 BTC. Do you see the dynamic there? The smart money is actively, almost hungrily, absorbing all those liquidations from the pivoting miners and the panicked retail traders. That supply is just being eaten up by high-conviction buyers looking at a multi-year time horizon.
And all of this builds toward a specific target. Analysts are now identifying $78,000 as the true market mean for Bitcoin in this cycle. This is absolutely the critical pivot point to watch as this current, frankly exhausting consolidation phase finally wraps up. $78,000 isn't just a random guess. It's effectively the mathematical center of gravity for where all this institutional accumulation is taking place.
Which leaves us with the ultimate question for you to consider today. If John Har's 9 reasons for a durable bottom hold true, and if whales are successfully absorbing that massive miner sell-off, then the current market dips really aren't a reason to panic. If we are structurally heading toward that $78,000 true market mean, is a dip towards $74,000 actually your high-conviction entry point for the next major leg up toward $85,000? It's time to stop looking at the daily noise, start looking at the structural math, and ask yourself where the smart money is positioning itself. Thanks so much for joining me on this explainer, and I'll catch you next time as we continue to decode the market.